We're on a very specific mission. We are going deep into the world of finance penny stocks, and we're zeroing in on those contenders trading under that crucial $5 mark. The idea, based on a recent analysis report, is to look for the next potential breakout story, maybe even the next SoFi. So if you're looking for a shortcut to understanding the key players and, the core ideas in this high-growth, high-risk sector, you are in exactly the right place. This entire deep dive is built solely on one comprehensive analysis report. It's focused purely on the finance sector's under $5 universe.
And we have to set the stage here just for context. In this analysis, a penny stock is strictly defined as anything trading under that $5 threshold. And crucially, the report included a clear mandatory disclaimer that we have to reinforce. These stocks are inherently highly volatile. They carry significant risk.
And that includes the potential loss of your principal, right?
The very real possibility of losing all of it, yes.
Okay, that high volatility paired with the sub $5 price point is critical. So what is the state of this whole universe right now? I mean, is the analysis finding a lot of good candidates, especially when we know the successful ones tend to, climb out of this category?
That's the fascinating part. Finding high-quality stocks in this niche is actually unusually challenging right now.
Why is that?
It's precisely because the market has already rewarded the stronger players. Many of the most popular names from the last few years have already graduated. They've proven their model works and moved way above that $5 line.
The analysis actually called this phenomenon the shifting sands, which makes sense. The successful models get rewarded and they just leave the penny zone behind.
Exactly. And for you, the listener, this is key. These graduates aren't warnings. They're actually proof of concept.
So who are we talking about? Who exactly has moved out of that under $5 range recently?
Well, that list really shows that the strategy can work. As of late 2025, the report highlighted a few names. You've got Finvolution, that's F-I-N-V, which just crossed over to about $5.25.
Okay.
Then there's PaySafe, PSFE, now trading around $8, and OpFi, that's OPFI, which is up around $9.50.
Those are some really substantial moves. And what about the ones that used like a corporate strategy to get out?
Right. The report also noted names like MoneyLion and Dave. They either had these massive valuation surges, or they used corporate actions like reverse stock splits to push their price well above that $5 threshold.
So they hit milestones and the market just completely re-rated them.
Exactly. They achieved something that made them look different.
So if all the successful domestic names have surged and moved on, what defines the candidates that are left? What do the ones that made the analysis's top 5 list have in common?
When you connect the dots, the candidates still under $5 that have, appealing fundamentals, they really share two main traits. They either have heavy international exposure, almost overwhelmingly in China, or they focus on these extremely niche digital services.
So things like AI or crypto.
Precisely. It suggests the opportunity comes with a very specific geopolitical or technological risk profile that's keeping those valuations down.
That sets the stage perfectly. Geopolitical risk versus earnings potential. Let's just jump into the list itself and see how those themes play out. We'll start with the dominant one, the China-based fintechs that the report calls undervalued profit drivers.
Okay, first up is LX, that's Lexin Fintech Holdings. It's trading around $3.23 with a market cap of about $540 million. LX is a leading online consumer finance player in China. It basically connects young, educated consumers with financial institutions for loans.
So what's the core idea here? Why did it make the list? What's the nugget?
The numbers. This is where it gets kind of astonishing. LX is just fundamentally cheap. The analysis states the stock trades at a remarkably low price-to-earnings ratio, a PE of around 2.2 times.
Wait. 2.2 times earnings. That is stunningly low for the finance sector. To put that in context for our listener, what would a typical stable U.S. bank trade at?
You're right to flag that. A mature, stable bank might trade at, 10 or 12 times earnings? Even a growth fintech that isn't profitable often trades on multiples of sales.
Not earnings.
Not earnings. That 2.2x is practically screaming market rejection. It is the ultimate sign of a geopolitical risk discount. The market is basically saying, we believe the earnings are real, but we assume regulatory risk could just wipe them out.
But for a deep value investor, that's the whole opportunity.
It is. It suggests significant undervaluation if those risks are contained.
A pure bet on risk management. Okay, that makes sense. Moving to the second stock in this group, WDH.
Right, that's Waterdrop Inc. It's trading lower, around $1.75, with a slightly larger market cap of $630 million. Waterdrop is firmly in the insurtech space. They run a digital insurance marketplace and also a crowdfunding platform for medical costs. And they use AI to match users to the right plans.
So we've gone from consumer lending with LX to health insurance with WDH. What makes this one a standout, especially compared to those high-growth, high-loss models we talked about earlier?
Stability comes down to discipline. Waterdrop successfully pivoted from just chasing growth at all costs to securing proven profitability.
And the numbers back that up.
The analysis highlighted that they reported a huge 60% year-over-year rise in net profit for the third quarter of 2025. That offers a relative stability that is just so rare in the microcap world. They've proven the model can generate cash, not just users.
Okay, so that brings us to the third stock, LU Lufax Holding. This one feels like a completely different profile. The report labels it the large cap contrarian play.
It is completely different. LU Lufax Holding Ltd. is trading around $2.65, but look at the market cap, $2.3 billion.
Wow.
That's massive compared to the others. Lufax is one of the largest personal financial service platforms in China, and they focus on loans for small business owners.
So it's a huge company that somehow got pushed into the penny stock price range. What does that do to the risk profile? I mean, a $2 stock with a $2.3 billion valuation versus, say, $500 million.
The liquidity improves dramatically. Its size provides a level of stability that you just don't find in a typical microcap.
So who is this for?
Contrarian investors. The ones who buy when sentiment is at its absolute worst. They see this low price as a potential bottom fishing opportunity. The whole thesis is a bet that China's credit markets, which have really faced headwinds, will eventually stabilize.
And if that happens, Lufax is positioned for a huge rebound.
Exactly. Because it survived the downturn due to its sheer scale.
That means we have our three big China plays, all discounted for different reasons. LX for its earnings, WDH for its profitability pivot, and LU as a macro recovery play. Now we shift to a really nimble tech play, HUIZ.
Yes, HUIZ, Huize Holding. We're back to the smaller end of the spectrum here. It's around $3.48 with a market cap of only $35 million. Huize is another digital insurance broker similar to WDH, but they focus specifically on customized life and health insurance products sold online.
And here's where it gets really interesting, especially on the tech front. The report says they're using something called DeepSeek. That feels aggressive for a $35 million company.
That's precisely the point. The analysis highlights Huize's nimbleness and their aggressive AI integration. They're integrating these advanced AI models to drastically improve their consultation services,
making it faster and more efficient than older competitors.
Exactly. A company this small has less legacy tech to deal with, so they can deploy new stuff much more rapidly.
So this is the specialized tech accelerator play. What are the metrics supporting it?
Well, despite its small size, the company has seen record-high premiums. And the nugget here is really the analyst confidence. Specific price targets were cited, some targeting over $4, all driven by this improved efficiency.
Okay, that leaves us with the fifth and final selection. This is a complete thematic shift away from China and into high beta volatility.
Mago Inc. It's based in Canada but trades on the NASDAQ. This is your pure digital wealth and payments app. Price is around $1.23 with a tiny market cap of $30 million.
Wait, only $30 million? That's smaller than a mid-sized apartment complex. Does a market cap that low just fundamentally change the risk assessment?
Oh, absolutely. It changes everything. A $30 million market cap means low liquidity and extremely high volatility. But the report explicitly labels Mago as a high beta growth play.
Can you define high beta for our listener just in the context of this specific stock?
Sure. High beta means Mago is likely to move more than the overall market. Because its business is so tightly tied to the excitement and volatility of the crypto market, its movements are just exaggerated.
So if crypto goes up 10%, Mogo might go up 20 or 30.
Right. But, and this is a big but, it cuts both ways. If crypto crashes, a stock like this could be obliterated. It's a direct way to play that future of finance theme while staying under that $2 price point.
That is just a fascinating spectrum. We've gone from deep value lending to two different insurtech plays to a massive small business lender and finally a tiny volatile crypto bet.
And if we connect this to the bigger picture, you just have to look at the huge disparity in stability. You have the size and liquidity of Lufax at $2.3 billion sitting right next to a microcap like Mogo at $30 million.
So while they all have that penny stock label,
their ability to handle market shocks are worlds apart. The risk exposure is just completely different.
That's a crucial distinction. Let's synthesize those core investment theses the analysis report highlighted.
Okay, the analysis really frames them on two axes. First, you have the value and recovery plays. That's Lex and Fintech, LX, and Lufax LU. They're based on existing scale and earnings power.
The idea being that the risk is already priced in.
Exactly. Then you have the specialized tech plays. That's Waterdrop, WDH, and Huize, HUIZ. They are profitable, or at least showing a clear path to it by using insurtech and AI. They're betting on being nimble.
And Mogo is just the total outlier, the pure volatility, high beta crypto growth bet. It's a thematic speculation.
And no matter where they sit on that spectrum, we have to re-emphasize the high volatility and significant risk in all of them. Knowledge is most valuable when you understand the risk, not just when you acquire a list of tickers.
So what does this all mean for you? This deep dive has hopefully provided a shortcut to understanding the key players, their specific theses, and the unique risks and rewards in this under $5 finance sector, all pulled directly from that one analysis report.
And to tie it all back to those graduated stocks we started with, companies like PaySafe and MoneyLion, this raises a really important question for you to consider. Look at the success of WDH and LX in achieving proven profitability, even under intense pressure. Is the true catalyst for sustained growth out of the penny stock range, for truly becoming the next SoFi, more reliant on achieving that proven net profitability? Or is it about relying on the promise of high growth, like a MOGO?
That is a fantastic point to end on. Does the deep value path with proven earnings like LX offer a more reliable route to graduation than the volatile, high beta crypto path like MOGO? The analysis certainly makes a strong case for focusing on that earnings power. Thanks for joining us for this deep